All right. Good morning, everyone. Hopefully everybody's having a good morning. The new trade signals for the vol trend strategy might have surprised a few people, so it's quite convenient that on the first day that we're taking a trade, there's also some office hours. So we'll get into all the questions that people will naturally have. And like I said as well, I'll go ahead and execute those trades in my software as well, those vol trend trades. So got a few people showing up. The other thing that I wanted to just mention really quick, I'm going to try something new today. It's, what is this? 13th private, did about 9, so about 22 live streams in. The one consistent theme is that I'm pretty terrible at managing time. So I'm going to try to do a hard stop today at 1 hour and 10 minutes. And when my little counter there hits 1 hour and 10 minutes, whatever, I'm just going to finish off the last question and then we'll push the other ones later on. So maybe it'll allow more people to feel like they can tune into a full live stream. It's just an hour. But if they go on an hour and a half, 2 hours, I do think we start losing people. So we're just going to try that. I don't want to be rude. This will be the first time that I do it. I don't want to look like I'm just abruptly ending things, but just fair warning, we're going to stick to an hour and 10. And I may have actually said this before and didn't do it, so we'll see. Let's see if I can actually stick to it today. So just wait a couple seconds here. My software doesn't let me see the chat until maybe 2-3 minutes in. So usually when the chat shows up and I can see that there's a few people commenting, then we can start. Yeah. There is also some annoying construction going on. I don't know if anybody can actually hear that or not. Once I switched to this style microphone, the dynamic style microphone, I've had a lot less audio problems. It's actually been a real lifesaver for me because usually when I'm traveling and going to different places and doing videos, the very first thing I have to do is find some type of audio store, music stores, and get all the sound panels and basically cover the ceiling, buy area rugs for the floor, hit the walls, all these, especially the corners, throw some sound panels in all the corners. But actually just having this microphone by itself has done a pretty great job. So hopefully you can't see all the banging and drilling in the background. All right, so it looks like the chat's up and running. So as you noticed, I'm sure some of you, many of you who have been following VTS Options were not thrown off by it, but I got a few emails today from people asking, what's the deal with the new strategy? I mentioned it several times in the past, but, sometimes people maybe don't read the blogs. But for the most part, it's not that new for most of you. But for anybody that it is, I think it's a pretty good timing today to have a live stream where I can actually show basically the only thing about the strategy is how to size the trade, right? As far as watching the strategy go and how it's capitalizing on different environments, that's only something that people are going to see over a long period of time. Certainly I could tell you that this is how it responds and this is the results. All of those are useful and I will show those, but really you have to see longer term how it benefits in which market environments, how it plays off the broad strategy. So as far as that, we'll just let it go. And in several weeks, maybe a few months later, you'll have numerous instances where maybe you thought it would react one way and it didn't, or maybe you were expecting it to do better and it actually didn't. And you'll be able to get a much better gauge of what the strategy is actually targeting and how it works. But the thing that, of course, everybody needs to know is how to actually size the trade, right? It's options trading. It's not quite as simple as just taking your allocation, dividing by the shares. There's that one additional step that needs to be taken. So I'm just going to, I see Wasabi or W Asabi. There's a few questions there. I will circle back. I'll get to those. But right now, I'm actually going to just talk through how people would size these trades, and I'm just going to go ahead and execute them right now. So People can see it once or twice. Every time that it's convenient, I don't mind doing it. That's actually why I funded this account at Thinkorswim. It's so that I'll actually have something to show people when we need to do examples. And in this case, I think it's actually quite important to do an example. So really quickly, what this is, as you can see, this is the leveraged total portfolio solution. So we've got the MVV for the balanced, QLD is in the defensive, and then SSO is part of the VB threshold. The only difference is, again, because this is a test account and I can actually just use it to show people stuff, I thought it would be more interesting if I traded the tactical volatility within this account. And so that's what you're seeing here. Instead of, technically it's supposed to be the aggressive vol strategy, but that's just long SVXY. I think that the VXX put options are a little more interesting for people. So I'm going to do that in this account as well. I do everything in my long-term portfolio. I do both, aggressive vol, tactical vol, plus all the leveraged and unleveraged strategies. I trade them all. But in this test account, essentially you're looking at the leveraged total portfolio with the tactical volatility subbed in. So right now we have a portfolio that is 80% allocated. It is essentially, if I scroll down here, sorry if that makes you dizzy, right here, the first 4 strategies before I added this 5th line here, the first 4, we are all allocated, and that's essentially what you see in the account. All I'm going to do is just add the 20% vol trend strategy. So all we need to do for this, and it is much easier than people think it is. Oftentimes with options trading, people just get frustrated almost immediately. And believe me, I can understand where that comes from. I typically use the example, for me back in school, it was always poetry and anything to do with English class, like reading novels and no matter how basic or higher level abstract it was, I would just immediately shut it off. My brain just doesn't want to even get into the deeper meanings. And I see it. I could probably understand it if I dedicate some time to it and I think, oh, well, this poem is meaning this. My brain just shuts it off. A lot of people are like that with math, and just even the most simple calculations that anybody can do, sometimes they just shut off. And so what I have to do is remind people that this is very easy. You will get it if you do just 1 or 2. It's actually quite simple. But I do get a lot of people who are just immediately turned off by options trading as soon as you show them even one calculation. And it's not that the calculation's confusing. Of course they can understand it. It's just that our brains have those reactions to shut things down, right? So just be open-minded if you're a little bit new to options trading and it's a little bit daunting. Trust me, anybody can do this. It's actually really simple. So what we are going to do is I'm just going to use these trade instructions and actually execute the trade. And I'm going to do both of these, right? In that test account, it's a margin account, so it doesn't matter. I'm going to execute both of these. So for the first one, the margin account side, this is for people who do have a margin account, right? This would not be for the IRA style accounts, or if you're Canadian, RRSP. These are for people who would just have a pure margin account where they can get options approval to sell naked put options on the VXX. If you've got a little bit of options experience, they'll probably grant you that permission, but you do need the highest level to sell uncovered options. But anyway, if you're in that situation, and the strategy works basically the same, minus a tiny little inefficiency that I'll get into in a minute, but it's basically the same thing. So if you can't do this one, don't think that you're somehow taking a huge step down to have to trade the vertical spread. It's very similar, and I'm going to execute both of them to show you. The difference is probably 1 or 2 cents. But we're going to go ahead with the margin account. So super simple. Actually, like I explained in the email, all you need to know is this line here. 1 contract per 1150 in capital. So if we look at my account here, and I'm just going to, no, I can do it on this calculator just to show everybody. I'm just not sure if this shows up, but hopefully you can see what I'm doing here. So I'll just take my net liquidation value of 953 and divide by 5. This is my vol trend strategy allocation for the day. This is how much money I can dedicate to the new trade. And so again, I'm going to assume, first of all, that I'm going to do it the margin account style. That's what this is. So I'm going to go ahead and do that. Remember, all I need to do is just divide by that multiplier. And the reason that's not right. 1150. The reason that multiplier is the way it is because the short strike we're selling is the 1150 strike. So all you do is multiply that by 100, and that's the multiplier. So really simple, I would buy 30.77 shares. Now, of course, you can't sell options with a 0.77, so we always round down just so that there's no inefficiencies with the capital that you spent a little too much. Might interfere with some of the other things you're doing. Always round down. So 30 contracts. Really simple. I'm just going to go to my trade tab. Of course, your software might be slightly different than this. If you're with Fidelity or Interactive Brokers, they're all a little bit different. I wish that they were more uniform, but unfortunately, they all have their little style and unique traits. But it should, in general, be about the same. So in Thinkorswim, I go to the trade tab. I find my trade, 1st of March, 2021. Okay, that's there. Of April. 1st of April, 2021, VXX 1150 put. All right, so I just go to the April contract, that's the weeklies, and I find my 1150 and I sell the exact contract, right? Sell the 1150 put. Now, here is where you have to do basically a little bit of discretion. Now, these VXX is extremely liquid, so it's almost always going to be a penny wide. Here, essentially what I do is I usually go to the mid price. Now, it says 22 on the ask and 21 on the bid, but technically I'm probably only going to get 21. To get 22, I would have to wait. I would have to input the trade and I'd have to wait, and then hopefully the market sort of ticks up a little bit, or the VXX maybe ticks down slightly more, and then maybe my 21 would go to 22. But in the moment, when you see 21, 22, you're not going to get the high one. The mid is in between, and you're going to get the 21. That's why, at least in Thinkorswim, it says NAT, the natural price. That's the price I'm going to get. So all I have to do is adjust my contracts to 30. Remember, that's just a simple calculation. 1/5 of my net liquidation divided by the 1150, and that's it. So you can check what you're doing before you do it, just in case you inputted something wrong. 33,800 is roughly the net liquidation I'm looking for. So I'm going to go ahead and execute this. And I believe I said 21. And like I said, it's going to go through because I'm using the natural, the mid price, but I've ticked slightly down. Now, this is where a lot of people, this is just a side tangent. Of course, the trade is done. It really is that easy. If you were to do a normal one, you divide your net lick by the share count, and that's how many shares you buy. With options, you just take your net liquidation divided by the 1150. It's basically the same thing. So nobody needs to be intimidated by the math or the options trading or any of that. But one thing that you noticed is that it said 21.22, and this is an email that I get all the time. Should people wait and try to get that 22? For me, my answer is always the same. For me, it's a no. And the reason I don't do that is not because half the time I couldn't get it. Probably half the time I would. If I inputted 22 and I really wanted that extra penny, I could sit there for maybe it's 5 minutes, maybe it's an hour or two, and maybe it'll tick up. But there's a 50-50 chance it'll tick down, right? So now I'm waiting for 22 and then it ticks down to 20. Now I lost the same penny. So for me, the most important part of the trade is the actual structure of the trade, why I'm doing it, the methodology behind what I'm doing, not so much the price. The price just comes down to what I get in the moment. I logged onto my software. When I sent the email, it was closer to 24 or 25. Right now, it's 21. So that's what I get. I don't try to get that 25 because 2 hours ago it was trading at 25, or try to get the prices I want. It is what it is. You open up your trade for all of the right reasons, and then you're just subject to the pricing that you are presented with. So I would say, I can't tell anybody what to do, but that's my general theory, is that I don't nickel and dime my option trades. That doesn't mean that I always go right on the bid. If there's a significant gap, then I will go the mid price, and I'll try to be a little bit patient, wait 30 seconds, wait a minute, drop it a penny down, keep doing that process. But in this case, the VXX is so liquid that it's going to be 21, 22, and the market would have to move in my favor to get that 22. I'm not a person who thinks I can predict the market 20 minutes from now. It's just an impossibility. I consider it a 50-50 proposition. It'll just as likely go to 20 as it goes to 22. So get the trade done. That's my answer to all of those people that are going to ask, why didn't you set it for 22 and wait a while? That's why, because I don't know if it's going to tick up or down. And not to be too presumptuous, but I don't think you do either. So let's just all agree that you just get the price that you're sitting at your computer at the moment. And in the long run, it'll all work out. So let's do the other trade. Let's say, for example, I am in some type of IRA style account where it's a cash account. You can only use the cash that is in the account, first of all, so it's not a margin. And then secondly, typically, in almost all cases, they're not going to allow you to sell a naked put option in an IRA style account or a tax sheltered style account. Now, I did get an email from somebody informing me that they are with a broker that actually does allow within an IRA to do that. So it was surprising to me. It's not unheard of, but it's not very common. So you may actually have to do the vertical spread. Now, the only difference between the vertical spread and the short put that I just sold is that the vertical spread, let me first show you the short put, right? This is what they all look like. Profit over here, straight down line, down to unlimited loss. Now, of course, practically speaking, it's not going to go all the way down to here. We've only got 8 days, and the VXX can't go very much lower than that. But technically, it's an unlimited loss trade. The only difference between the two trades here is that, sorry, I have to resize this. The vertical, why isn't it showing me? Sorry, I'm confused here. What is, oh, sorry. I had my own trade highlighted there as well. So the vertical spread, just ignore all that. I'll edit it out later maybe. The vertical spread, all it does is very low down. It just buys a longer put option. And essentially, this caps the risk. So this trader can only lose this much money no matter what happens. Now, in a practical sense, it's almost the identical trade because, like I said, practically speaking, the VXX can't really go to 9 or 8 in 8 days. It just doesn't, volatility doesn't crush down that quickly. But from a broker perspective, this is now a limited loss trade, and most brokers will allow it. So if you're in one of them that does require this, you can still participate in vol trend. You just have to trade the vertical. Now, what that is going to look like, I'm going to execute this trade now as well. What this one's going to look like, the only difference is that I have to buy that put option. So when I highlight the string, I just sold this 1150. I actually have to buy one of these. And the one that I'm going to buy every month is the one that is 1 penny. Right? So sometimes it might say 01 to 02. Sometimes it might say 0 to 01. I'm not going to buy this one because that's slightly more expensive. And I don't want to lose too much inefficiency here. I want to make sure that the difference is as close to 1 penny as possible. 2 cents at the absolute maximum. So I'm going to actually buy the 950. So we're going to go to the trade screen. It's going to be the same number of contracts, right? You would go to your calculator. You would take your net liquidation value. It's now slightly different because it's just a few minutes have passed. Divided by 5. This amount divided by that multiplier that is in the emails, right? That's just the strike price we're selling times 100. Again, it's the same 30 shares because we have to round down. So I'm going to do 30 of these. Again, with the only difference now, it's called a vertical spread. You can see it there. Now, with the vertical spread, first of all, I can adjust my contracts. I'm going to do 30 of them. Remember, I have to buy the put option. So this one that says plus, I don't want the 11. That's too expensive. Remember, I wanted that 950. As far as pricing on verticals go, you can see how it's a penny lower. It's actually probably going to be 2 cents lower. It's typically 1, but just with the way that the computers are matching this up, it could be 2. But what you could do is try to get the 20 now. Because it's a vertical, you could try for the mid. So I'm just going to go ahead and see. It's very likely not going to go, but 30 contracts, and there we go. And I did get it. So that's what I was going to say is while I was waiting for it to execute, I was going to explain what I do in this case. Because the vertical spread is matching 2 contracts out there, these are computers. It doesn't take long. You don't have to sit in front of your computer for very long. But because there is a little bit of a difference there between the bid and the ask, you can go on the mid always, wait 30 seconds, wait a minute, see if you get your price that you want. And if you don't, then drop it 1 penny, wait for another minute, try again. Again, these are computers. You don't have to wait all day long. You don't have to do it and then wait 2 hours, but give it a minute and see if it goes. In this case, it did actually go through for 20 cents. So what you can see is that I actually bought both of those. Now it's going to look a little weird because when we highlight it, I'm going to have 60 of one of them. But just remember that 30 and 30 is the vertical, and then the other 30 is the naked. But you can see that the only difference was 1 penny, right? So I took the trade. Unfortunately, due to slight inefficiencies with brokers and IRAs and regulations and whatnot, people who are trading the verticals, they will lose typically 1 cent. There will be times when it will be 0, just the way the mid prices work out on the bid ask. And there will be times it could be 2 cents. But long term, I always say it's going to be 1 penny difference. And that's it. So when we take a trade for 21 cents, and I'm going to use the 20 for the slightly less efficient vertical, 20 cents divided by 1150, which is the strike we chose, this is essentially a 1.739% return over the next 8 days. Now, typically, if you did these 8-day cycles, oftentimes I do 3 to 5 days, but this is the extra week. So we won't get quite as many of these, but there could be 20 a year or something. And then you might get some losses as well. So say 15 a year, but it may not sound like much, but at the end of the year, these little 20-cent trades could easily end up equating to a really good rate of return. And I mentioned before that it's not exactly possible for me to audit my private account because unfortunately I use the VXX for several different strategies, not just that one. So no auditor is going to actually agree that, okay, we're going to pair all these up just like he says so. How do they know I'm not just cherry picking the numbers? So unfortunately, I can't audit my account, but the long-term performance is in that sort of 23, 24% a year range. And that's how it happens. A whole string of what seems like small trades, right? It doesn't seem like much, but you add up 10 cents here, 20 cents there, and you do it 30 or 40 times a year, it actually can add up to a pretty good rate of return. So that's how we went through this trade instructions. This might change over time. This was sort of my first shot at it. I'll wait to see at the end of today and tomorrow how many emails I get, how many people kind of don't understand what they're looking at. I might tweak a few things, but this is the only information you need. So that's why I included as simple as possible. But that's what they look like. So now we are in a trade. And this trade probably, unless something happens and derails the trade, we're going to be in this probably until next Thursday or Friday. And that is the vol trend strategy. Now, what should I do? Should I open the questions? Or there's one question I know somebody's going to ask. So I'm just going to preemptively answer it, and then I'm just going to jump into the questions. So the one question I always get, and it's a totally valid one, and it's coming from a person who understands options trading, this type of question. They always ask, how come you label it as a short volatility strategy? Because that's kind of how I view it. The reason that I'm getting this question is because when you sell a put option on the VXX, mathematically, you want it to go up. It's a long delta trade, right? So you technically are long volatility. We want the VXX to go up so we can get our premium. So that's the right answer. Technically speaking, this is a long volatility strategy. But the reason that I say in a practical sense, the way that I trade the strategy, I view it as short vol still, or at least something in between, not quite short vol pure, but pretty close to it. The reason is because my ideal expiration price for the VXX next Friday is $11.50. Right? I don't want the VXX to just go up and so I can get my easy premium. What I want is I want the VXX to continue bleeding downward. I just want to make sure that these contracts that I'm selling, it doesn't breach by too far. Now, obviously you get weeks where the VXX just crushes through your barrier and you end up losing money. That happens all the time in trading. But technically speaking, the vol trend strategy works by volatility declining. If we get some massive spike, what that means is I'm going to get my 20 cents almost immediately. And then I'm out of the trade, basically. So I got one win. And then I'm going to have to wait several weeks for volatility to start declining again before getting into new trades. What I actually want to happen is exactly this. Maybe not quite this violently, but what's going on there? Certainly something like this, something like that is fine. All of these downdrafts, and even the spike. Remember the spike, we don't lose any money when it spikes. You might lose a couple of weeks because you probably shouldn't sell VXX puts after a spike. But yeah, I'm looking for volatility to continue to decline. That's why when I say, technically speaking, mathematically, it's long vol. Practically speaking, it is definitely a short vol strategy that benefits from the long-term decay of the VXX. And so preemptively answered that question. Again, I'll answer that many more times in the future. It's a very common question. So let me check the time. 25 minutes. Sorry, that was a little long. I thought I could get it done in 15. But we did 2 trades. We did both the margin account and the cash account. So when I timestamp this all out, I'm going to, you can come back to it. You can watch it again. Your software might be slightly different, but it's really, really easy to do. So the vol trend strategy, while it's technically options, don't let that sway you. It's basically one button click and you can get these things done as well. So not quite the VTS options of old where we're doing calendars and Iron Condors and all of these layered diagonals and whatnot. I can understand why people are turned off by that. But the vol trend is a very, very simple option strategy. Basically, I think anybody could do it. So hopefully you like it. I think it's going to be a great addition to the portfolio. Of course, we won't know until we have more data to show you, but you'll see how it works with the rest of the portfolio. It's actually quite good. There are times when it can insulate and reduce drawdowns, and there are times when it can boost performance by adding those results. So time will tell, but I think everybody's going to like it. So let me dive into these questions. Like I said, I'm going to try for a hard stop at 1:10. Sorry, I ramble too much, but that's probably better than not rambling enough, right? So here we go. Why the VTS options consists only in the vol trend strategy. I mean, why not Iron Condors anymore? It's because, which spreadsheet do I have open right now? No, I can just say it. So in the past, the recent past, VTS options has just recently been put on temporary hold. We were doing Iron Condors, calendars, diagonals, butterflies, straddles, everything, right? Verticals, all different. There were 7 different strategies being traded. Pure options service. The vol trend strategy is basically the one individual VTS strategy that works the best with this portfolio. Iron Condors are probably second. So just to give you a little history of VTS, I started my business in 2012, January 2012. And for the first 7 years, there was a 20 to 25% allocation of a pure Iron Condor strategy called VTS Iron Condors. Creative, I know. VTS Iron Condors was in the portfolio for the last, the first 7 years as a pure strategy, and then the last 3 years as a part of VTS options. So I agree with you, Iron Condors are great. And if I had to choose, gun to my head, it's probably the second best pairing, but the vol trend is the best pairing for the portfolio. And what I wanted to do is put VTS options on hold, focus on the VTS stuff, get it all cleaned up so everybody understands. It's built sort of over time and I keep layering, and I've not been very good at explaining the early stuff anymore because that was, 8-9 years ago for me. But there's a lot of people who come into the business brand new and they have no idea what they're looking at. They're looking at 1,000 articles and videos and, dashboards, and all this stuff is overwhelming to them. For me, it's just, well, that's just what it is. Just follow it. It's so simple. It's in the emails. But that's not being sensitive to the fact that I've been building this for so many years that I probably should go back and do a few things to make it easy for newer people. And so VTS options is on hold. It will not be gone forever. I will figure out a way to bring it back better than ever in the future. But right now, for the next several months, this is what it's going to be. But I don't disagree that there are plenty of other option strategies that are also worth trading. It's just, I wanted to choose one to get the full 20%. This thing is awesome paired with a broad portfolio, so that's why it's in there. Is the overlay starting today? No, the overlay is not going to start until I give people an opportunity to move over to the annual subscription. Of course, there'll be discounts for that. Nobody's paying any more money. Most people are going to be paying a lot less. But I do want to give people the time to sort of do that. Because once I get into it, I kind of want it to be it is a private community. And I want it to be something that a lot of people have a chance to participate in sort of right from the beginning. I don't want to be rehashing things as 5 people join and then 10 people join. If we can get a pretty good chunk of people in the beginning, I think it'll just work better from the start. So I can't give you an exact date on when I'll begin that, but it shouldn't be longer than, say, 2 weeks-ish, something like that. And then we'll start to do it. What I just did today, that could be viewed as an overlay. What I just did is I basically doubled up my position, right? The only difference is 1 penny. These are essentially the same trade. Because I'm in this portfolio, I'm leveraged long in MVV, QLD, SSO, and we've got a tactical volatility trade on. There's no reason why a person in my position with a margin account, like you can see that there's over half the account is available to trade still. There's no reason why you can't bump that up a little bit. And I'll go into all the reasons why I'm comfortable doing that and saying that. But it's just something that I want a larger community to see kind of right from the beginning. So give me a couple weeks and then we'll start, there'll be private live streams just for the overlay and for the annual people. I shouldn't call it the overlay, just annual subscribers. And yeah, it'll be pretty good. I think people will like it. But I want to do it right because it's a little bit tempting. Once you start seeing it a few times, it's tempting to get too aggressive. That's people's general default temptation in the entire investing world, not just for that. There's going to be people say, well, how come you just doubled it? Why don't you take a 4 times position or 5 times position? There's going to be plenty of people who are saying that. So I want to make sure that I do this right and explain that you don't want to turn a great opportunity into calamity just because you're too aggressive. So give me some time. What are your thoughts about VOLQ? Since we have quite some long tech equities in our portfolio, shouldn't we look at VOLQ as well? I do. I consider VOLQ is essentially the NASDAQ 100 VIX sort of replacement. Doesn't have options yet. I don't think it's a huge volume thing yet, but yeah, you can start looking at all those things. I still consider the VIX and the VOLI to be the 2 main volatility indexes that people should be looking at. And the only reason is because there's a whole lot of bleed over and correlations and super high correlation between S&P 500 options activity and NASDAQ options activity. So I think the VIX does just fine to capture whatever you're looking for. You could go directly to the underlying, right? But even in the case of, say, treasuries, right? Treasuries are obviously even less correlated than these 2 indexes. I still don't often use the Treasury Volatility Index for gauging the pulse of the market. I still do use the S&P 500 as a broad gauge pulse. So yeah, there's an Apple VIX. There's a VIX for Apple. There's a VIX for Amazon. There's plenty of VIX style calculations for all the more specific stuff. There's oil, there's gold, there's all of them, right? But I still do consider the VIX to be the overarching one that you want to focus on. Maybe if you'd have some specific reason you want to dig a little deeper, you could do that, but I don't find the VIX overly useful to begin with, so I don't really look at VOLQ much these days. Okay, Richard asks, can you go over getting fills? When the email came out, bid was 24, went down to 21. I've been told not to buy options as a market order, but get filled has been a challenge. So you're absolutely right that you should never trade options with market orders. And that statement becomes increasingly stronger the more legs of the option you are doing. So if I were to have done a market order for that single short put that you just saw, it would have been the same result. I would have gotten the 21 and it would have been fine. If I did a market order for the vertical, remember we were dancing around. I wasn't sure whether I was going to get the 20 or the 19. If I do a market, I'm surely getting the 19. that's why you don't want to do it. And then on an Iron Condor, you're gonna always get that bad fill price. So always do limit orders and always target the mid price, right? Like I said, don't nickel and dime, don't wait all day for it, but target the middle. As far as the difference during the day between 24 and 21, that's trading. I mean, it could have just as easily gone to 28, and this question would have been, well, I felt bad I didn't wait longer, right? It's totally intraday random. I think the market, all these people that think that they can time intraday movements, I think it's, not to be too mean, but it's very convenient that they also don't show their performance, because I don't think there would be any. Trying to time the market intraday isn't something that I personally believe is possible. So whether it's 21 when I send the email or 24, I took 21.20 on those two trades. I'm perfectly fine with it. If it went down to 15, it is what it is. There's not that much difference. It's just sometimes it works in your favor, sometimes it doesn't. Assume that long term, because on an intraday basis, this is just a random walk. It's just noise. The difference in 2 hours, 3 hours here and there, assume half the time it's going to work in your favor and half the time it's going to work against you. Long term, law of large numbers, it's going to be the exact same thing. So don't worry about it. I've been trading options for 15 years, and this is not something that I spend any time worrying about. You just, like I said, the trade is what's important. The reason you're doing it, the day that you're doing it on, your risk management plan for what happens if it goes wrong. That's what you focus on. The actual price you get is just what you get when you sit in front of your computer. So don't worry about that. Another question here. Did I send out the link for discounted annual rate? I have not. There is one on the website, but don't sign up for that one because your price will be cheaper than that. And if you do accidentally sign up for it or have recently, refunds are coming. Don't worry. Actually, that brings me to another question. Just as far as the refunds go, you're going to have to give me a couple weeks because I just noticed it recently that I actually kind of made a mistake, a little business management mistake where maybe 8 years ago, I had a situation in PayPal where I just logged in one day and my balance was zero. It was, $20,000 or something, and the balance was zero. And it was weird. They just took the money. And it took a few months of paperwork and back and forth emails and discussions with their team to get the money back. I did get the money back. You can't take someone's money. But since then, I've always had the policy that every 2 weeks I withdraw my money and I send it to my bank. And so now that I'm having to do these refunds, unfortunately, the refunds, I'm going to have to refund like $40,000. So you're going to have to give me a couple weeks here for the income to come back into the account because, about 2 weeks ago, I withdraw the money. So it'll be soon. It won't be very long, but just bear in mind that I can't actually do it this week because my PayPal account doesn't actually have 40 grand in it right now. So give me a couple weeks on those refunds as well, if you don't mind. There is a historical return on VTS options. How does the vol trend strategy differ from it? Good question. What spreadsheet do I have open? Let me just close this. Open a new one. Sorry for the delay. The two spreadsheets that I'm opening and closing should be fairly quick. These are the two main ones that I have that it's not going to break my live stream doing this. All right. I'll just wait for this thing to load up. I would have two, but everybody who's been following me for a while, you know my problems with spreadsheets. I just have too many of them and they're too long. Too many compatibility issues and problems. Come on. All right, here we go. So what you're essentially asking is, because VTS Options does have performance, how close is it to that? So this is the VTS Options performance since 2012. Now what this is, just for people who are not really familiar with the history of VTS, like I said, from 2012 when I launched, all the way up to March 2018. So all the way up to right there, it was entirely Iron Condors. And then in March 2018, I had a lot of demand over these previous 2 years for me to share some of my other strategies. So that's when we branched it off to go to VTS Options. And it's a separate service. And that's when I introduced all of the other strategies as well. And so from this point on, this is VTS Options. This is Iron Condors, diagonals, verticals, all of those trades. The Wheel of Fun, the vol step, it's everything. And the long-term performance is about 17%. Now within this, of course, from here to there, within that, there were some what we call the Wheel of Fun. Some of them were on stocks. A lot of them were on things like AEO, and CVS was an old favorite for a while. And some of them are on the VXX and the UVXY. So it's pretty difficult to remove just the vol trend out of this because there isn't that many occurrences. I think there's only been about 12 in the last 3 years. But now that we're going to be doing hopefully 2 to 3 per month, it's going to be different. But those trades actually will be slightly better than this. So if you were to use this as a baseline, there would be nothing wrong with that. If you said, look, vol trend has, until you prove otherwise, vol trend has an expectation of 17%, that would be just fine because the live performance for all of my option trading since I launched in January 2012 is technically 17% a year. Very, very consistent upward line. I'm very good at managing risk through options. That's what it is. A lot of people use it for speculation. Options is a risk management tool, so you should be able to produce reasonably stable performance. If you want to do that and just say, yep, it's 17 until you show me otherwise, check back in 3 years, that's fine. It's probably slightly higher, but I'm not going to, that's splitting hairs. Essentially what you saw is what it's, I don't have a crystal ball, but that's kind of what we're targeting, that similar return rate, the similar shape, the drawdown reduction. It should be fairly consistent as well. But no actual way, because it's not a pure systematic strategy. There is discretion involved. So there's no way that I can actually show you a back test because entries, exits, strike price, expirations, there is a little bit of discretion there. There's a skeleton structure that I like to just repeat over and over, but I can't show a back test. So if you want to use just the VTS options as a back test, it's going to be quite close. Okay, so will vol trend lower returns for leveraged portfolio? You say it should return 23 to 24, while the leveraged portfolio is close to 30. Couple things here. The leveraged portfolio has returned 30, but let's slow down a little bit on thinking that that's just going to be what it is forever. Obviously I have to prove that over time, I suspect it'll be lower just simply because the markets in general are going to be substantially lower. Stocks at all-time highs, interest rates near zero, can't raise rates any further or it'll bankrupt the Western economies. So as far as a standard stock bond portfolio, getting 2 or 3% going forward is going to be good. So it's probably just, it's wishful thinking to think that you can make a 30% annual return when the standard benchmark of all the investing world is going to struggle to make 2 to 3. So I always try to drag people's expectations down as much as possible. Again, I always sort of default to the 1% a month, sort of 12% annualized return number as a really, really good baseline. So that's just the first thing. It's not what you asked, but I just want to draw your attention that 30% a year is, there may not be a single asset manager in the world that gets 30% a year starting today for the next 30 years. There may not be any. Of course, as we know, Warren Buffett is considered one of the best. His actual verified track record is considered one of the best ever. And even his, which includes the 1960s, 70s, 80s, 90s, the golden years, even his was, 23, 24, and he's worth $100 billion or something. So, it's been fantastic so far, but don't use that number as an anchor. That's called anchor bias. Don't anchor to the 30 and say, vol trend might only make 24, that's worse. Who knows? Adding more, the better. If you have 4 strategies that work really well, adding a fifth one that also works well, regardless of whether maybe it's a little bit lower rate of return, that makes the 5 strategy portfolio better. It's just stronger. It's more resilient to unknown events. Its drawdown reduction is a little bit better. So 5's always better than 4. As long as all 5 of them on their own are good, then mixing them together is just going to be better. I can't speak on the performance. Maybe leverage portfolio will only make 22 and vol trend will make 35, and then it would be totally inverted. And you'd think, wow, vol trend's adding performance. Could be the other way. I just know that it's better. 5 good, solid strategies with a proven track record is better than 4. So let's let the numbers fall where they may. Okay, interesting. Newbie here. No problem. We all started at the same place. Any idea why your VXX trade is 421, but my platform only has 423? Let me just see what you're talking about here. Because it's not... Oh, I see what you mean. Let me just do a screen share. You're probably just seeing it visually wrong. So I can see kind of here it says 1 APR 21. You might think that that says April 21st. This is actually April 1st, 2021. That's the lingo there. So if we go to the actual contract, the one that I chose here is this 1 APR 21. Like I said, I was going to do the 26 March, but premiums are kind of dipping a little bit low there. So I just went 1 week out. But this is the 1st of April, 2021. Not this one. I mean, maybe you're looking at this one, the 23rd of April. No, we are doing the 1st of April, 2021. That's that lingo in the email. Short 1 April 2021. That's why I added the little dash there to show that that's the year, this is the day. So don't be confused on that. Hopefully that was your question. Sometimes I have a bad habit of reading an entirely different question that the person didn't ask, but hopefully I got that one. All right, here we go. We use June puts to short volatility. Right, the tactical volatility is currently in the June $18 long put options, and that is a short vol trade, right? We want VXX to go down, and those put options will profit. Would a short put vertical do the same job done without the risk of huge spikes? Perhaps more trades when winners must be rolled, or am I wrong? The problem there is that you're not technically wrong as far as rate of return goes. You may find that if you were to just repeat verticals, you may actually be able to produce a similar rate of return. But the reason that the long puts are so good is because there's no capped gain on a long put. It can make as much as it can make. Whereas if you're doing verticals, of course, you're capping gains and losses. So it's no longer a strong trend following strategy. It's more of a short-term trader type of strategy. And in that case, you wouldn't go all the way out to June either. You'd probably want to use just the monthly cycles. You're fairly new. I know you. I don't think you were too long in VTS options, but we do something called the vol step strategy, which is essentially what you're getting at here. We do either long put verticals or we do short call verticals as that VXX is sort of declining and the UVXY, and we're basically just trying to repeat them. And what ends up happening is, yes, you can make a good rate of return doing that. The vol step strategy was a very good one, but it's totally different risk reward dynamic than a pure trend following strategy like tactical volatility and like aggressive vol. When you just buy SVXY, there's no cap on the gain you can make. I mean, I've had a trade in the past that, let me get my spreadsheet. Is this the right one? It is not. My bad luck today. I have a spreadsheet showing all of the cumulative gains of all the individual trades of tactical volatility. And there's one of them that's over 100% gain. A few of them that are in, the 50, 60, plenty in the 10, 20, 30. That's what trend following does, is it's just you're just switching the risk basically. So the tactical volatility will tend to sort of spin its wheels for quite a bit of the time and then go on these really good runs where it can actually get a good rate of return. Whereas the vol step strategy, or like you're alluding to using verticals, that would be more consistent gains coming more often, but with less potential for those really high profits. So doing verticals, you're never going to make 50% a year or 80% a year. It doesn't work that way. The options market's very efficient. But like you said, you're probably not going to take massive losses either because the losses are protected. So totally different trade. Might be similar result, but they both get there in entirely different ways. Tactical vol is a pure trend following strategy. What I'm trying to do is avoid as many of the bad days as possible. Sometimes you'll go several months with no gains at all, and then you'll hit like a 2-3 month period where you're up 40%. And that sort of makes the 1 or 2 year return what it is. Whereas the vol step strategy looked much more similar to the VTS options. Consistent, but lower return. So do both. Experiment with both. They're not mutually exclusive. You can definitely do both. All right, we used to do weeklies. We're doing a week and a half. Vol has crushed massively recently. What are you looking at to determine probability of 1150 not being breached? Okay, several things interlaced here. I like this question a lot. First of all, there is no set amount. Like, there's no set expiration cycle. It just so happens that recently, in the last 4 or 5 we've done, have been anywhere from 3 to 5 days using the same week. So maybe sell it on the previous Friday for the following Friday. But again, with options trading, blind selling of anything is a losing proposition. You have to add an additional edge of some kind in order to produce profit. So it's not going to work out that every Friday we sell one and then the next Friday's expiration and we just rinse repeat. Nothing in the options world should ever be rinse repeat. That's a surefire way to get your rate of return to approach 0% minus trade fees. That's what blind trading should come to. 0% return minus trade fees. If the options market is efficient, which it is, that's more or less what you'll get. So the first part of it, don't expect that it's always going to be some weekly or, sometimes we'll do 8 days, 10 days, sometimes 2 days. It just depends where it lands. The second thing, vol has crushed massively. What are we looking at to determine the probability of 1150 VXX not being breached? Well, I keep pretty detailed statistics on these types of things. So I know the odds of it breaching that. But essentially, if you look at the string, my basic thought pattern, of course, I looked at all the math and the probability is not great. Of course, it's very low that it'll reach 1150. And even to go down 20 more cents because we added our premium to 1130, the odds of that are low. That does not mean it can't happen. Of course, this could continue and we could easily breach. But remember, long term, let me open up that spreadsheet. It's actually more interesting. Remember, I hope that was the right one. Long term, the VXX decays about 1% a week. So just the fact that it's crushed so massively recently it might be giving people the impression that somehow the VXX goes down 5 or 10% a week. I wish that was the case, but it's just not. It goes down about 1.1% a week. So the odds of it going from 12.20 when I actually sold it, I think it was 12.19 on the VXX, to 11.50 is quite low. So then it's just a calculation of what's the overall portfolio doing, what's the beta factor of the actual portfolio to the S&P, and what's the beta of the VXX to the S&P, and then taking a 1/5 leverage factor of that, and I essentially arrive at a probability of this trade costing more money than I'm comfortable with because it will start eating into the profit of the broad portfolio. So there's quite a bit at play there, but if you wanted to simplify it, let me go to my sheet here. VXX long-term decay. Remember, the VXX long-term only decays 1.186% a week. This is long-term since 2004. Now, obviously, there are periods where it decays 3, 4, 5% in a really strong week. Others where it just spikes violently and it takes forever to get back. But long-term, we're only talking about 1.2%, let's say, a week. So if we're talking about a 1250 contract or an 1150 contract on a VXX at 1220, that's 70 cents. and then we add the 20 cents that we sold, we are 90 cents away from our break even. Based on a 1220 VXX, it would have to go down 7.37% for us to break even. Now, could that happen? Of course, absolutely. It just happened last week, probably. But probably what's going to happen is it's not going to get there. But like I said, this is a quasi short volatility strategy. It's not actually short vol, but I do want it to go to 1150. That would be really, really good. Probably what's going to happen is those are just going to expire worthless. All right. Hopefully they expire worthless when the VXX is at 1150, because that would mean that this trade, Tactical Vol, did very well. And all three of these more than likely will also do extremely well, because for VXX to be at 1130 by next week, yeah, that would be good for us. So there's a lot of detailed calculations going into it. It's not just me sort of on a whim saying, hey, the 1150 sounds good. I don't know how far you want to go with it, but that's sort of what I do, is calculating how fast the portfolio moves compared to how fast the VXX moves, make sure all my allocations are correct, make sure that I do allow for a little bit of a band there, because beta factor, while it's a super useful tool for determining these things, it's not a uniform thing. It's not consistent. So the beta of the S&P to the VXX, it has a long-term number, say 3.3, minus 3.3. It's not always 3.3. It can range +5, +6, -4. It can vary quite a bit. So, but that's where I would start if I was you. Yeah. Did I get it? Did I get that question right or no? All right, we have 15 more minutes. Let me speed this up. Oh, that's cool. Looks like there's only 4 here. How many people are watching? Okay, so yes, I've been getting burnt, getting unbalanced overlay too heavy versus long portfolio. Was not happy with myself, but learned. Not doing that again. Yeah, that's one of the things that I'm glad you learned the lesson. This is a lesson that I promise you everyone will learn. It's the default reaction of all of us to take something that works really well and just try to ramp it up as much as we can. That's one of my jobs, right? As the person who's managing a service you're following, one of my major jobs is as a risk manager and stopping you from doing things that I've already made those mistakes in the past so other people don't have to. I'm going to be explaining to people on the overlay strategy that if you get too aggressive, you can take what should have been a very good month for your portfolio and you can burn all of that capital by having the VXX bleed too much. And then if you happen to get that's the first punch that you get hit, you allocated too much. And then the second punch might be that's just one of those months where the beta factor of the VXX to the S&P decouples and the VXX decays even faster than the stock market is going up. Then you're going to get punched again. That's why I have that band threshold again to add another beta factor lower, sort of a 30% band lower, just in case you get one of those. Because remember, I'm pairing my vol trend trade essentially partially based on my other allocations that I have in the portfolio. If you get a week where the VXX decays a rapid amount and stocks don't go anywhere and you're over leveraged to the VXX, boy, you can burn all of that capital. So yes, it's one of those things where you could take a golden opportunity to boost your performance of your portfolio and you could just totally ruin it by doing it wrong. That's kind of one of the general principles of options or any trading really, is that there's a lot of things that work if you do it right. And anything that's really good can be ruined if you do it wrong. So it's not so much it's what are you doing? The what are you doing matters, but how you do it can make or break the strategy as well. So I've run the numbers and I've done this for so many years that I can probably be there to sort of guide the community into, holding the reins back, so to speak, because I know most people are going to want to get in there and just double, triple, quadruple leverage. No, that's not what you should be doing. This is an opportunity to get a nice little kicker to the portfolio. Let's not ruin it. Okay, Chris, new subscriber here. Welcome. Thank you for joining. When we do the short vol through VXX puts, why do we take 3 months out and 0.7 delta? So what you want to do first is you probably want to go onto the YouTube channel and shut myself and trying to do it somewhat blind. Shut that person up. Go onto the search button here and just put stock replacement. Okay, there's going to be a 2-part series here. Part 1, why do we do stock replacement basically? Part 2, how to actually do it. I show that through the VXX. And then if you really wanted, part 3 is the tactical volatility strategy, which I sort of updated it a little bit. It's an older video, but I've updated a little bit, and it talks about stock replacement as well. So go through that 3-part series, and you're going to have a much better idea. The short answer for you would be because the biggest risk to buying long put options is theta decay. So if you are doing 1-month contracts, theta can start burning significant amounts of your capital, and gamma as well. So gamma is the second order Greek of delta. Basically, the closer you are to expiration, the more those shock moves can influence the underlying position you have. Because you're shorting volatility, losses are always more punishing than the gains. Gains happen somewhat slowly, losses happen extremely quick. So you don't want to have high gamma on your options trades, and you also don't want to have high theta because you're long that option. So if you stretch it out to 100, 130 days out and always rebalance like we will, if this trade is open really much longer, it's almost time for a rebalance already. And then we'll just take it a month out further and just do the same trade. What that does is it reduces the gamma. So if you do get hit by something, right, it might move a little bit less, but it also reduces the theta factor. So it's just a way to avoid that bleed taking too much of your profit. There's no way to avoid it. You do bleed capital when you're long put options, but the trade-off is that it's a much safer position, and I like paying that theta to get the safety that it brings. The other part that you asked, just really quickly, why the 0.7 delta? It's just because liquidity-wise, that's probably the best you're going to get. 0.6, 0.7, in certain cases, maybe 0.8, but because we're going further out in time, we actually don't have the liquidity on all of the strike prices. It tends to be concentrated a little bit more in the middle, closer to the money. And so we just get what we get. 0.7 delta would be good. We typically actually land about 0.6, to be honest, long-term average. And I'm fine with that. I don't mind taking a 0.6 leveraged short vol position. It's basically 0.6 of the VXX. Totally fine with that. The current SVXY is 0.5. So a 0.7 delta VXX put would be a stronger trade than the SVXY. And then there's a slight theta bleed, but it would be stronger. I don't mind that. Anywhere in the 0.5 to 0.75 range is pretty good. VXX straight up since your put sale. Nasty. What does that mean? Wait, first I'll screen share. What does that mean? VXX is at 1234. So I don't know, maybe I'm misinterpreting that. For the actual VXX put, that means it's profitable, right? Of course, if the VXX goes up, technically you'd be making your money. So the 1150 that I sold at 21, it's already down to 1650. So the trade has made money. The rest of the portfolio more than likely would have lost money in the last 20, 30 minutes. So I don't know what part of the nasty is. Is it nasty for the broad portfolio, or is it nasty for the put? Because the actual vol trend strategy technically doesn't care if the VIX spikes up or the VXX spikes up. I do, though. I want it to go down. I'd love to see it at 1150 next week. By next Friday, that would be awesome. But we don't get to choose the market, so it is what it is. All right. Check the time. Still good? The tactical volatility strategy. Why is the alternative to buy VXX put to long SVXY? Isn't the former a short vol strat and the latter a long vol? No, they're both very, very similar underlying position. A long VXX put option and a long SVXY, just holding the shares. These are both short vol positions, right? The long VXX put option benefits if the VXX goes down. Long SVXY benefits if VXX goes down. The only difference is SVXY is a 0.5 times leverage factor. After they deleveraged it, that happened on February 27th, 2018, ages ago, but it did happen after the Volpocalypse. It was deleveraged from -1 to -0.5. The VXX put option, actually this month, our delta was 0.51. So they're almost identical positions. But maybe we'll do 0.6, 0.7 delta sometimes, so it's a little stronger. But basically they are 99% correlated to one another. Those are the same. It's just different signals, right? Aggressive vol is more aggressive, as the name suggests. The reason it's called aggressive vol isn't because the underlying position is aggressive. It's because the trade frequency is much higher. The tactical volatility, it only trades about 42% of the time, whereas aggressive vol is about 68%. So it is more aggressive. That's why it's called that. See how creative I am? That's why I asked everybody to please just help me name my live stream, because if I was to name it, it'd be called live stream. I mean, that's about as creative as I get. So the aggressive vol strategy is aggressive because it is aggressive. There you go. That's how my brain works. Pretty simplistic, not creative at all. Okay, I was saying that your VXX trade has made money instantly. Yeah. Oh, see, I'm old. Nasty is slang for be right immediately. Is it? See, nasty to me is a negative. You're using nasty as a good thing. Slang for being right immediately. You've got to be way younger than me. I'm not going to argue with you. You're obviously, I don't get out much. I'm mostly on my computer and don't talk to too many people day to day. I'll take your word for it. So nasty is a good thing now. Okay. That reminds me of that. Can't even remember what movie it's from, but you remember Steve Buscemi was in that movie where he dressed up as a high school kid. And of course, Steve Buscemi looks like a 60-year-old man. But he's little, so he dressed up in like this outfit that a high school kid would wear. That's how I feel right now, is that if I go around there talking about, nasty and saying terms that younger people say, it's going to be like me, Steve Buscemi, saying, what did he say? What's up, my fellow kids, or whatever he said, and he's like a 60-year-old man. Pretty funny. That's me. I'm old. Out of touch with all these things. There was another one in last stream. Somebody taught me a slang. I had to look it up afterwards. Okay. So that's it for all the questions, at least on my end. You know what I should do while I'm sitting here? Just bear with me a second. I'm going to load up the YouTube and check the comments on the actual... It's January 2018. On the actual stream. I have noticed that every time I check this, it does match up exactly. But when I do the public live streams, I think that might be because there might be a whole lot more questions coming in. And so people sometimes email and say, I missed a bunch. I'm sitting here. But I don't. Okay, here we go. So we had... Tactical vol, will you do more than 2? No, it's the same. It's exactly the same. So that's probably just because the volume of questions is so low in the private streams. All right. So this is the last one that I see. I misread today's email. So when you say long SVXY equals VXX put equals long VXX. Nope, you had it till that last one. Long SVXY is equivalent to a long VXX put, at least directionally. Those are the same things. They are both short vol positions. Long VXX is the exact opposite. That is long vol. So when you look at the emails and you see tactical volatility is a long put option, that's a short vol position. This is an entirely short volatility strategy. Within VB threshold, when we buy the SVXY, that is a pure short volatility position. And then again, aggressive vol, long SVXY, pure short vol. Those are different then the ones over here we will occasionally take, which is long volatility. 1/2 VIXY is a mirror image of VXX. I like to use different tickers and different strategies so people can sort of keep tabs if they happen to be trading multiple ones. But yes, we will go long VXX eventually. It does happen. But VXX puts are a short volatility position, just like SVXY. This kind of gets to my point before. When you nickel and dime, what you're going to find is that 50% of the time it goes the wrong way on you. So you're looking at a price, it's 20 cents or 21 cents. And obviously we all like money, so we want 21 cents. But yeah, if you waited, you think, I'm going to get 20. I'm going to get 22. I'm going to wait for it. Well, now it's 16. All right, so that's kind of how it happens. And it could have gone up to 27. I don't know. And maybe by the end of the day, when I officially take the trade, right, I executed this live, but the official strategies, all of them on the website, they all take end of day pricing. Who knows what it's going to be at the end of the day? I can't predict that. So I'm sitting here now. It's 11:10 in the morning for me. Markets close at 1. So I've got 2 hours. Basically, in order for me to know what premium to take, I would have to know which direction the market's going to go in the next 2 hours. Well, I mean, how arrogant / delusional would I be if I actually said I'm the type of person that knows where the market's going to be 2 hours from now? Nobody does. There's a lot of people who say they do, and there's a lot of people who will tell you that they do, but I don't mind saying that I have no idea. The market might recover very strongly into the close, or it could sell off into the close. I have no idea, but there's nothing that I can do right now, sitting in my chair, to make a realistic expectation of where the market's going. There's no data point I could use. There's absolutely nothing. It's just take the price when you're sitting at your computer, and long term, it'll be fine. So I guess some people might be getting into it at 16 or 17. It's just, it is what it is. Don't get bogged down on the pricing. That doesn't mean waste your money. Obviously, go for the midpoint and never market orders. Always limit orders. But yeah, you should get your option trades done within a minute. Typically, mine are done within 10 or 20 seconds. I don't see any value in trying to get that last tick upwards, because it could very easily just tick downward. So, all right. 1 hour and 12 minutes. I said hard stop at 110, so I did it. And the problem is I feel rude leaving. That's the thing I'm not good at. I could actually just sit here for several more hours, but let's try to keep them fresh. Let's try to make more streams, shorter streams. And yeah, good one. So hopefully everybody saw the trades. Everything that we covered, you can ask again in the next live stream. And if it happens to coincide, I can do another trade, or I can just do another trade. I'm lucky enough that I have a margin account, and I can do other test trades for you as well. So I can go through those trades as many times as you need. Thanks, everybody. Have a great day. Yeah, I can actually go running now. So hopefully this doesn't seem rude. I'm kicking you out of my house here, but yeah, have an awesome day. Thanks. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.